As the summer rally sizzles on, there's no denying this market has proven resilient, even when faced with the looming threat of a possible recession. The S&P has rallied 17% since the June 16th bottom, and we've seen decisive pockets of strength that tell the tale. Investors appear to be gravitating back toward large cap growth and doing away with short-term credit as they attempt to navigate a possible Fed pivot. Joining us now to break down the trends is Tom Lydon, Vice Chairman at VettaFi, Matt Bartolini, head of Spider America's research at State Street, and Tim Johnson, Blue Horizon Capital partner and co-founder of Cycle. Guys, thank you so much for being here. It's definitely the trifecta today. Matt, let's start with you. Given the sudden shift that we've seen from kind of the recent rally, it seems like investors are a little concerned about risk, at least today, Friday. Is that what the flows are telling you, and what does that indicate about a potential trend, as we finish out summer and head into the fall?
Yeah, so I think what we've seen from buying behavior is that investors, are sort of acting as if it's a summer of cynicism. They're not really buying so much into this rally. Flows have been positive. There's roughly about 44 billion of inflows in the month of August alone, which is generally around historical averages. But over the past 3 months, that trend is definitely lower than what we've seen historically. We've also seen lower participation within some of the ETF marketplaces where not a lot of flows, funds beneath the surface have had inflows. Particularly in the month of August, if it was not for U.S. equities, which took in over 30 billion so far, the equity segment alone would have actually net outflows. So there's definitely been a lack of conviction. There's been a little bit of pessimism towards this rally of how it will last. We're obviously seeing some of that being given back today. The S&P 500 really failed to break above the 200-day moving average, and that's been a sort of a line of demarcation. There has been some positive green shoots, though. More recently, we've seen some positive flows into sector exposures. That's the first time they've had inflows in the last 3 months. But when you dig beneath the surface, it's still defensive positioning. Defensive sectors like healthcare, consumer staples, and utilities, those areas that typically have worked well historically in times of slowdowns or recessions, continue to be allocated to. So again, summer of cynicism. Perhaps we'll go to the autumn of optimism when we get to the fall time period.
Autumn of optimism. I like that. Tom, kind of along that same vein, in terms of hedging and short selling, ETFs often used as a way for investors to get exposure to both directional bets to the downside as well as hedging out specific positions in their portfolio. We've seen short positions kind of rise with the tide of the market in recent weeks. What's the sense you get there that it's a directional bet or fears that investors have that the market has just run up too high versus just the fact that the market, at higher levels requires more in terms of hedging?
Yeah, I'd kind of take the other side of the bet that Matt just laid out. I think advisors, and we're surveying advisors all the time, are the most positive they've been in over a year. We're seeing positive flows back into growth. We saw $42 billion go into growth ETFs off of that low. That's key and critical, very important. And also where we saw net redemptions in fixed income ETFs in the first 4 months of the year, we've actually seen money come back into corporates, into high yields, and leaving areas that were safer, like short-term duration, and also dividends. Got a lot of flows in the beginning of the year, and actually in the last couple of months have seen some outflows. The surveys we see from advisors are saying because the Fed is a little bit more clear on the rising interest rates and they're fighting inflation, they're less concerned about, yes, there'll be a recession, but how deep that recession will be. So then in turn translates into them being more bullish on the market.
Interesting. Tim, I just wanted to get your take. As we wrap up the broader market segment, do you feel like that the overall sentiment is kind of at this inflection point?
Yeah, I think the reality is that this broad transition, as we look at it from the new energy economy, is continuing to be strong. There's clear leaders. There's clearly a whole bunch of innovators that have done a lot of work over the last couple of years. And whilst there may be short-term pullbacks, at the end of the day, we see that the trend is continuing. We see that enthusiasm for the sector remains strong, even if in the short term there's some skepticism around what's going to happen day to day.
All right. Well, let's move on to one area that's seen kind of the will they, won't they in terms of fiscal stimulus. We're diving deep into clean energy plays. The Biden administration, of course, taking steps to combat the climate crisis with last week's passage of the Inflation Reduction Act, sparking questions about the new energy economy. What will the ripple effects be on supply chains and beyond as we move toward a more energy efficient era? And what are the most crucial alternative energy sources out there? Tim, the administration pledging a lot of capital here, about $370 billion worth in energy and climate incentives, more spending in this area than any other single piece of legislation Congress has ever passed, according to Goldman. That's mostly, though, in form of tax credits. Give us your take on this bill. Who do you think stands to benefit the most?
Yeah, absolutely. I mean, well, it's very clear that the administration is using the carrot in terms of trying to incentivize people to domesticate or at least work with fair trade countries in order to bolster the supply chains that are necessary to build out this next generation of infrastructure when it comes to both sustainable energy generation, but also how we use that energy, we're talking about all the way through, of course, to electrification. This capital that's flowing in through the administration, it's not just coming in the form of loans and grants, which is some of the things that we've seen in the past, but it's also coming through in the form of tax incentives as well. So what we're expecting to see is a structural benefit that's geared towards some of these companies that are really helping with this overall transition.
Tom, let's get more specific. Companies or types of companies. What's your take on this? We've seen a big push toward clean energy ETFs. Do you think this could be the next big catalyst that drives further flows in those companies or specific industries that stand to benefit from it?
Yeah, it's not as though clean energy has been new to the ETF space. There have been some great ETFs that have been around for over a decade. Two of the biggest, the iShares Global Clean Energy ETF and the Invesco Solar ETF, collectively have $9 billion, and both are up pretty well year to date. I think what Tim's alluding to, though, is you need to look at other areas. You need to look at smaller companies. You need to look at companies outside of the U.S. You need to look at companies that may not just be battery or solar. You need to look at producers of lithium, cobalt. We're going to need those minerals as we continue to move this clean energy process forward. And that's really going to be key and critical. Most of those ETFs that we have today that have billions of dollars in them tend to be cap weighted. So there's more invested in fewer companies. I think Tim's approach is a little bit more broad-based, where it's more of an equal weight approach. So you have the opportunity to invest in smaller companies and have it be meaningful on the performance side.
Well, Tim, why don't you tell us? You've got this new energy ETF. It's all about exposure to a wider rate of renewable energy sources. So what is in it? What is your approach here? How did you do the screening to determine how to structure this particular ETF?
Yeah, absolutely. So we look at it from the new energy transition being broken up basically on 5 broad segments, being energy generation, energy distribution, energy storage, performance materials, as Tom was alluding to, is a big part of what we do. And then, of course, e-mobility, ultimately how we utilize that energy. And what we're saying is that effectively that this transition is really broad-based. It's not just here in North America, it's global. We invest all the way around the world. And what we're trying to do is we're identifying what we consider the leaders. So this is like the companies that everybody has in any new energy ETF, companies like Tesla. But we're also focused on developing and incorporating the innovators. So this may be in areas like new types of battery technology. So groups like Solar Power are in our ETF because we see them as being an important part of this transition as we go forward.
Yeah, we just need some more IPOs to increase the amount of available clean energy companies to invest in, but it sounds like you're doing okay in the meantime. Well, thank you all so much for being here. That does it for this week's ETF Edge. I'm Leslie Picker. My many thanks to Tom, Matt, and Tim for joining us today, and thank you for watching. You can find all of our latest videos right here on our website, etfedge.cnbc.com. We'll see you next Monday, same time, same place. Have a good week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.